If you are an expat setting up a trust in Dubai, tax is usually one of your first concerns. Not just how it is taxed locally in Dubai, but how your home country or country of tax resident might treat it. And that's exactly where things start to get complicated. Dubai doesn't impose income tax, capital gains tax, or inheritance tax on trust. That's often what makes it attractive in the first place. But that doesn't mean you can ignore tax treatment in other jurisdictions because trusts don't operate in a vacuum. They cross borders, interact with global banking systems, and often involve beneficiaries living in different countries. Understanding how Dubai trusts are treated for tax purposes is critical, especially if you are a high net worth individual with international assets, beneficiaries in multiple countries, or ties to high tax jurisdictions. So, in this video, we'll walk through what you need to know about the tax implications of a Dubai trust, both locally and internationally, and also how to avoid the most common mistakes that can trigger unwanted tax consequences. Before we start, my name is Shiraz Baid and I'm the founder at Lepidus Wealth, where we help clients and families protect their assets using a range of tools including trust, foundations, wills, and offshore structures. So, if you own a business or real estate, don't wait until a legal or health crisis to start thinking about protecting what you have built. Instead, request your free and customized asset protection plan by clicking the link below. You can then implement it step by step as your journey progresses. A Dubai trust, whether established under the DIFC or ADGM law, it is a legal arrangement where trustee holds and manages assets for the benefits of one or more beneficiaries. It's often used to protect assets, manage succession, or separate ownership from control. But what it's not is a way to disappear from the tax system entirely. While Dubai itself doesn't tax the trust income or assets, most expats are subject to taxation in their home country or country of residence. And that's where reporting and classification comes into play. Some countries like the US or Australia have strict rules around foreign trusts. They may treat a Dubai trust as a grantor trust, transparent entity, or even disregard it altogether, depending on who the settler and beneficiaries are, where the assets are located, and whether the trust is revocable or irrevocable. For example, if you are a US person and you set up a DIFC trust, the IRS may require you to file multiple forms, including Form 3520 and 3520A, even if there is no tax due. Failure to file can result in substantial penalties. Likewise, if you're an Australian and your Dubai trust distributes income to a resident beneficiary, that income could be taxed at the beneficiary's marginal rate set by the ATO or the Australian Tax Office. It is also important to think about the Controlled Foreign Trust or CFT rules. In many jurisdictions, tax authorities look through trusts to see if the settler still retains control. If they do, income might be attributed back to them. Even if you have structured the trust properly under the Dubai law, a foreign tax authority might recharacterize it based on effective control and benefits. Banking can also create tax friction. While Dubai trusts can open bank accounts, particularly with private banks in Switzerland, Singapore, or Dubai itself, many banks are now cautious when onboarding trusts. They often require FATCA or CRS declarations, detailed KYC files, and information about all parties involved, including protectors and beneficiaries. These disclosures can trigger tax reporting in home country jurisdictions. Another consideration is deemed disposition. In some countries, for example, Canada, transferring assets into a trust can be treated as a taxable event, even if no money changes hands. That means capital gains could be triggered simply by funding the trust. And for expats who move to a high tax country later, the assets inside the trust might be subject to exit tax or reporting requirements upon immigration. Dubai trusts are also sometimes misunderstood as opaque or secretive. In reality, they are becoming increasingly transparent. The DIFC, for instance, requires certain information to be lodged with the registrar. While this registry is not publicly accessible, it is available to regulatory bodies. Moreover, international reporting standards like Common Reporting Standard or CRS apply, meaning that financial accounts, held by trusts are reportable to tax authorities where beneficiaries or settlers are resident. One of the biggest mistakes that we see is assuming that the Dubai Trust automatically creates tax efficiency. In some cases, it might do, especially for asset protection or deferring taxation across generations. But in others, it might trigger tax in places that you didn't even expect it. The key is understanding the tax residence of the parties involved, how distributions are handled, and what kind of reporting is required. It's also worth noting that not all trusts are created equal. A discretionary trust, where the trustee has full control over the distribution, might be treated differently than a fixed trust. Likewise, a revocable trust, where the settler can unwind it, is often treated as a look through structure in many countries. If your beneficiaries are minors or live in high tax countries, special care must be taken. Distribution to children, for instance, may be taxed at punitive rates in some jurisdictions. Others may treat trust income as part of the parent's taxable base. None of this means that you shouldn't use a Dubai trust. In fact, they remain one of the most powerful tools for succession planning and asset protection in the region. But it does means you need proper cross-border advice, ideally before you fund the trust or name beneficiaries. What we often advise is a two-step process. First, to ensure the structure complies fully under the Dubai law. That includes choosing the right trustee, filing the deed properly, and understanding your rights as the settler. Then assess how your home country or countries will view the same structure. That might require working with tax counsel in more than one jurisdiction, especially if you have a family spread across continents. With the right planning, it's absolutely possible to enjoy benefits of a Dubai trust without falling into compliance traps. But it takes foresight, not just paperwork. As I mentioned earlier, if you own a business or real estate, don't wait for legal or health crisis to start thinking about protecting your wealth. Many people think asset protection is only for ultra wealthy. But the reality is that some of these solutions cost as much as setting up a free zone company in Dubai. If you want to secure what you have built and ensure your legacy, you can request your free and customized asset protection plan by clicking the link in the description below. And if you're serious about building long term financial security, you should really check out my next video right here.